Good morning, ladies and gentlemen. Our team will be presenting to you a fundamental analysis into the two companies called Khanh Foods and Hormel Foods. Okay, the reason why we choose the two companies are because there is a very good comparability between the two. Both of them are S&P 500 constituent stocks with a similar market capitalization of close to 15 billion US dollars. Both companies primarily operate in the packaged food industry, where they both own a very established portfolio of household brands. And in recent years, after the financial crisis, both companies has engaged aggressive expansion strategies in the recent years. Okay, so for this presentation, we are going to divide into individual company analysis. First, Khanh. So after a series of analysis, our team has come to a conclusion of a strong buy recommendation for Khanh with a target price of $49.36. Reason being so because we believe that Khanh stock price is undervalued, and the recent strategies to cut down costs has been very effective. Okay, so Khanh company has been underperforming recently with untapped potential growth. Its recent acquisitions in 2013 has been underperforming, but recently has picking up and finally turned profit-making in the recent quarter, and is expected to grow even further. On top of that, many business units within Khanh has been undergoing serious restructuring in order to adapt to the changing environment where the customers and consumers are more price sensitive and health conscious. Last but not least, Khanh has engaged in various hedging techniques to hedge against its risks against the rising trend of the raw material prices. And one very interesting fact about Khanh is that it engages very high level of debt, with its debt to equity ratio at 56%. And with the recent low interest rate environment, Khanh has successfully reaped the benefit by having a cost of capital at 5.68%, a very low level compared to its peers with the same credit rating. Now I shall pass on the time to my teammate Khanh, who will be talking about the financial analysis. Khanh, please.
Okay, thank you, PC, for a very interesting presentation. So next, I would like to talk more about the financial analysis. So there are 3 points that I would like to emphasize to all of you investors. So firstly, we are going to expect a falling sales revenue in the next 5 years. Why? Because we expect a very stiff competition in the next 5 years. Moreover, because of the planned cutting cost strategy, actually they have a very strong divestiture plan in the next few years. So with more business being divested, we expect a falling sales revenue. Moreover, we also see a deteriorating solvency position for Khanh. This is because for the past 5 years, Khanh has borrowed a lot of cheap debt in order to finance its acquisitions, such as the rail corporation companies. However, this has led to an increasingly high debt-to-equity ratios from 1.38 in 2010 to 2.62 in 2014. So, lastly, however, we see a very good free cash flow positions. This is the result of effective cutting cost strategy. The evidence of this is that we can see the operating expense over sales revenue ratios has been improving from 14.8% in 2010 to 11.3% in 2014. So with this kind of financial analysis, this is our free cash flow based valuations. We made 3 key assumptions. The first one, the sales revenue is going to decline by 2% for the next 5 years, because during the worst year of financial crisis, the sales revenue only declined by 3% for Khanh. So even that with more divesting of unprofitable business, we expect the decline to be about of 2% for every year. And with the high level of debt, we also expect the debt repayment of 847 million annually. And lastly, we expect the terminal free cash flow growth of 1% annually. It's because overall, the US economy grows by 2% every year, and being in the staple food industry, we expect the Khanh terminal growth to be a bit slower compared to the rest of the economy. So let's go to the free cash flow table. You can see the free cash flow of CyberLink is generally very healthy, between the 1 billion to 855 million, although it's declining due to the fact that they try to pay more debt. And so, with all of the calculations, our recommendations is that we have a strong buy for CyberLink stock. These are all of our model parameters, and with the equity value per share of $23.36 per share, we also take into account of other methods such as the discounted cash flow, the PE ratio, as well as the book to market approach in order to come up with an average target price of $49.36 per share. And compared to the current stock price of $37.85, we conclude that is a very good buy for all the investors. However, we also see that the WACC of CyberLink is very sensitive to the interest of the Federal Reserve, the US Federal Reserve, because more than 50% of capital of CyberLink come from debt. So even that if Fed raise the interest by 1%, this can hurt CyberLink quite a lot. So we do a scenario analysis for CyberLink. As you can see, as the WACC decrease, the equity per share value actually affected quite a huge extent. And for the long-term free cash flow growth rate, we also see that as the free cash flow growth rate increase, the equity per share of CyberLink also increase accordingly. So next, I would like to pass on to my teammate Kenneth to talk more about our competitor, Hormel.
Thank you, Carl. The second company under our analysis is Hormel Foods, which is a giant food manufacturer that produce different food and markets in different global markets. As demonstrated by this chart, these are the 5 major business components of this company, and demonstrated by the next chart, this is its global presence in the world. So, based on our analysis, the intrinsic price for this company should be $44.37, and the market price traded in the stock exchange is currently $58.03. And we believe that due to this huge overpricing, the natural investment recommendation is to sell and take a short position. All our investment recommendation can be summarized into one sentence, which is which we categorize Hormel as a stable performer, but with a low future growth potential based on the 3 major reasons. First of all, we believe that the company is having a strong fundamental and stable in its past performance. Next, we believe that its broad product portfolio as strong manufacturing capacity can definitely add value to the company. And finally, we believe that its growth potential has been hampered by its underusage of the cheap debt. And I will go into more details into these 3 points. First of all, we believe that by analyzing its past performance, we have found that the company has definitely demonstrated a balanced capital structure of debt and equity, as well as a very stable revenue and earning growth over the past 5 years. And we believe that all of this shows a strong fundamental of the company, as well as a very promising future performance as well. However, next, the company's business can be divided into 5 major components, with 50% mainly comes from its refrigerated food segment. The other 50% has been fairly shared by its other 4 business alternatives. We believe that this diversification can add to the stability of the company. Other than that, the company's strong manufacturing capability also add value to the company. First of all, the company has 3 wholly owned plants that can produce strong manufacturing volume to the company. Secondly, the company is having 37 facilities that produce and distribute other manufactured items all over the world, which also enhances its global presence. And finally, the company has 7 turkey harvest and processing operations over the world, which can also contribute to the effective diversification of the company. All of these factors can contribute a very stable, can create a very stable performer which is Hormel Foods. However, one of the most important bullish factor that comes to our attention under our analysis is that the company has not been using the cheap debt enough. Okay, its growth potential has been hindered by the underusage of the low-cost debt. Between the year of 2011 and 2014, Hormel's long-term debt remained low as 250 million, which is only about 2% of sales growth. This is certainly too low for a company like this. And the next, Hormel's underusage of its low-cost debt, which is at an effective rate of 2.23%, can potentially hinder its long-term growth since the leverage provided by the debt has not been fully capitalized to amplify its growth. With that, I will pass the time to our teammates Timothy to talk about the financial analysis of the company.
Thank you, Kenneth. Now let me move on to financial analysis of Hormel. Firstly, we expect debt financing costs to remain unchanged. Why? It's because Hormel's long-term debt current debt has a maturity of greater than 5 years, and they are not expected to take on any additional debt in the next few years. Secondly, sales is expected to continue growing steadily at about 6.59% as we had forecasted, as we had calculated based on the past 4 years, and this growth is expected to continue in the next few years to come. Lastly, profitability remains high for Hormel as they have been performing consistently well since 2010, ever since they recovered from the financial crisis. They have also experienced a high ROA ratio of 11.05% in 2014, which far exceeded the industry average. From this graph, you can see that Hormel's ROA has outperformed the industry average quite significantly. During our financial analysis, we made 3 key assumptions. Firstly, sales revenue is to continue growing for 5% in the next 5 years. Although our forecasted figure was at about, estimated figure was at about 6.59%, we decided to take a more conservative approach and use Hormel's management's estimation of 5% instead. Secondly, the interest expense is expected to remain constant because Hormel is not expected to take on any additional debt, and Hormel's current long-term debt is expected to mature only in 5 years' time, past 5 years' time. Lastly, we assumed that the terminal free cash flow growth rate of Hormel will only grow at 1% annually based on the same assumption as ConAgra that Khanh has mentioned earlier. Here's our free cash flow projection. As you can see, our free cash flow is quite healthy and grows steadily from on a year-on-year basis. However, if you compare to ConAgra, you will notice that it is much lower than ConAgra's projected free cash flow. Why? It's because ConAgra uses a lot of debt to finance its operations, and in order to calculate the free cash flow, you have to add back after-tax interest on debt. And that's why Hormel has a lower free cash flow as compared to ConAgra. Here's our recommendation. Our recommendation is to sell. Based on the model parameters, we have come up with an estimated equity value per share of $33.59. And using the PE ratio, book-to-market value approach, and the discounted cash flow approach, we have come up with an average target price of $44.37. The current stock price, however, is valued at $57.96, which is much higher than our target price. Therefore, we recommend you to sell. We have done a scenario analysis based on our WACC and the long-term free cash flow growth rate. Why? Is because our long-term free cash flow growth rate is one of our key assumptions. As for the WACC, the Federal Reserve is expected to raise interest rates soon. So we wish to find out how sensitive our calculated equity value per share measures up to the changes in WACC and long-term free cash flow growth rate. And as you can see from here, our calculated equity value per share is actually quite sensitive due to from the changes in the WACC and the long-term free cash flow growth rate. However, we do not expect the free cash flow growth rate, the WACC to increase significantly because most of Hormel's long-term debt is expected to remain constant, and they are expected to mature only after 5 years. So WACC is not expected to be affected as Hormel's capital structure is based mostly on equity. Thank you for listening to us. We hope that you'll consider our opinions and we welcome any feedback.